Hey everyone, so welcome back to the next part of the Nelnet deep dive that I'm going through at the moment. If you need a brokerage account, please use Interactive Brokers. There's a link in the description below. It's the one that I use. I think it's the safest in the world, and I don't want anyone losing money like some crazy event like FTX happening. Interactive Brokers has a long track record. It's probably better to have 2 or 3 different brokerage accounts. One of mine is Interactive Brokers anyway. So link in the description below, and let's jump back into Nelnet. And we're going to look at some of their metrics, and we're going to look at their growth opportunity as well today. So firstly, on the screen here, you can see their book value per share growth. I think this is the best way to see growth of a conglomerate. As you can see by this graph, it's exceptional. They've got an exceptional track record here. Now, regarding margins, it's hard to gather with all the different segments and the different styles. Some of their businesses like renewables and Allo have large upfront investments, so the margins are negative. And then other businesses like Huddle and the fax software business, they have really high margins. So margins aren't the way to look at this. We look at individual margins for each of the units. It's probably the best way to look at it. Now, looking at the return on invested capital and return metrics, it's also a bit hard to gauge because of the different investment cycles of their businesses and their segments. I think it's best to just measure their book value per share growth historically, and that their hurdle rates for investments internally and for their acquisitions are minimum 15%. Let's assume return on invested capital is around about that number, 15%. And they've been deploying all of their money by the tables we saw in the previous episode. They've been actively deploying everything they can into different investment. And that book value has been growing at 17% compound annual growth rate for 20 odd years now. So I'm pretty happy to run with that. Regarding debt, it actually, if you go look at the financials, it looks pretty large, but that's kind of because it's a conglomerate and they got some weird things going on here. They got the bank, they got the student loans. So debt gets a bit complicated with all the different styles of business they have. The track record and the way they speak about debt is really encouraging, but it's a bit of a black box here. And they have talked about how they've hedged with interest rates, their debt, so that they're paying reliable, stable interest rate payments on their debt that they have. But there's a lot of this is going to have to be trust and management on the debt part, and that's why I wanted to focus so much on the management earlier. Free cash flow growth, if you look at the graph here, it can be a bit deceiving because of all the chunks of cash that come into the business and it's lumpy, but the overall trend is probably the way to look at this. As you can see in this graph, it is trending the right direction. Then if we look at shares outstanding, shares have actually come down overall about 2% per year on average. So the company has been buying back stock when they see it's attractive, which is quite often. The dividend, there is actually a small little dividend. It's under a 10% payout ratio. That's okay. Essentially, it's showing us that these guys are most likely not fraudulent, because if real cash is going out to shareholders, well, then they have to account for that, and it's real cash going out to shareholders. It's not fake. It's not fake money, not just on paper. So they're making money because they have to return some of it. I'm okay with it as long as their payout ratio is small, which it is. I like them plowing all their money back into all their opportunities. So then regarding incentives, Mike Dunlap, the chairman, owns 42% of the shares. That's a huge piece. Jeff, the CEO, has about $50 million of stock and a $2 million salary. That's inclusive of his bonuses. So that's maybe a little high, having $2 million a year. I don't know whether you need $2 million a year, but anyway, the stock ownership that he has is well over 10 times his salary. So I'm pretty okay with that. I think the incentives are easily aligned with us as potential shareholders, and this, especially with Mike having a 42% stake, this is essentially their baby. Now let's talk about the growth opportunities. And I think this is really important to the thesis too. So I think it's cool having this conglomerate and their focus on these different segments, that they essentially don't have a lack of places to invest. Renewables needs lots of money and has lots of cash flow opportunities to come. Nelnet Bank, Allo. There's just so much runway for them to reinvest. It's a big reason why I like this business. This isn't going to taper off and we just start getting increases in dividends and share rebuybacks. No, this business is going to compound away. I think they've got unlimited runway potential here. So many areas to invest in if they're good capital allocators, which I think the track record is proving that they have been. Even with the dramatic change that happened in 2010, they've been able to still be able to reinvest at high rates and add value to this business, which has been, the track record says everything you need to see. But it definitely isn't all perfect. Let's do a competition analysis now, not in too much detail. I'm just going to go through each of their segments and just talk about, each of the competition domains that they're in. So for example, renewables, that's pretty high competition, but once they're in a particular area, it becomes a sort of monopoly, a regional monopoly once they sort of work with the government in a particular area, but it's hard to get that contract in the first place. There's a lot of competition to win that deal. Allo the same with their fiber optics into towns. Nelnet Bank, there's a million of options for banks out there, so that's high competition. But then I think the loan servicing business has really low competition. I think the education software business is really low competition, especially with that awesome churn, those awesomely great churn rates. And Huddle, I think, has really low competition. They're effectively a monopoly in the high school, college, sport broadcasting world. So there's high competition, there's low competition. Again, this is a great reason why having some diversification is really cool. And looking at the track record of that book value growth means that overall, these things are doing well. Now let's get to that possible yellow flag. So see, because a lot of these are tied to councils, states, or government, they can interfere, especially with that loan servicing business. See, government being the customer just is tricky, and they could wipe out $60 to $100 million in income very quickly with a change of government or a change of decision, and that could be a pretty bad outcome for the business. When we'll get to later, they're making probably around about 400 million a year. This could be a quarter of their net income each year get wiped out by a government decision. So having one particular customer for a big piece of your business is I guess the yellow flag that I'm trying to refer to. But again, because they're diversified, not just in government businesses, it's like breaking one of the legs of a table. They've got 7 or 8 other legs to stand on, which will be, it'll hurt, but it won't crush them at all. I've looked at it, it's probably going to be about a 20-25% hit if the government was to bail out on the loan servicing contracts, which apparently they've just got renewed as of the day I'm recording this, which is late April. So it's looking good for the short term, but that doesn't mean things can't change. Okay, I think we've got all our ducks in a row now. I think we're ready to move on to the valuation, which I will do in the next video. I hope you're enjoying this little Nelnet deep dive series here and understanding what's going on. It's been fascinating for me to break it down like this, and I hope you're enjoying this kind of structure. Let's do the valuation tomorrow. I'll give you my final opinion, and then we can figure out whether we should invest or not. So I'll see you there.